Hey guys, it's CJ Investing here, back with another video, and today I'll be doing my top 5 stocks to buy for the month of April 2023. So this is my watch list on Yahoo Finance app. For my number 5 is going to be, I'm going to go with Johnson & Johnson, as you can see here. And you can see the price movement over the past 5 days, month, 6 months, year to date. Year to date is down like 13%. Its day range, all of these stocks are going to be like things that are kind of close to the 52-week low range. As you can see, Johnson & Johnson's 52-week low is $150.71, and it's pretty close to that. It's at $152.92 as of this market recording. So as you can see, the price to earnings ratio is 22.76%. Market cap $477 billion. As we go down, we see some news. Johnson & Johnson seek to U.S. Supreme Court review on units bankruptcy. 2 stocks that should be better buys after their spin-off this year. I think Johnson & Johnson is pretty much a good buy. You can really buy it at any point, but I would prefer, seeing as I'm a value investor, I would prefer it at a cheaper price. And I mean, you should too, because it increases your chance of getting gains from the stock. Even though Johnson & Johnson is not a growth company, as y'all probably know as dividend investors, but you can still get some growth out of this company just based on the market going up and based on it being relatively cheap compared to what it was trading at in the past. So Johnson & Johnson, y'all probably already know this company, use the products, etc., etc. But some of these products are like Aveeno, Clean, Clear, Neutrogena, which I use, and Aveeno baby products. You know, you got Listerine, you got your Tylenol, cold, flu, and allergy products, Benadryl, Zyrtec, which I just took a pill earlier for my allergies. They got a bunch of products. They got a wide variety of product list, and I'm sure you own some of their products. You know, they're drug manufacturers, they're in the healthcare sector, so it's a very safe company in my opinion. So that's something to check out. I don't have to look at what the analysts think about it, because it's not going to be much growth projected for it, as I said earlier. But looking at their financials, you see total revenue of $94 billion, gross profit was $63.8 billion. You always want to look at the profit, not just the revenue, how much money they're able to keep. As you can see, their diluted share count it went slightly up from 2019 to 2020, then 21 it went down. Quarter over quarter, you always want to look at decreasing share count, because you don't want to be diluted as a shareholder. And that's a big thing in the investment community that people don't check, is if they're being diluted. As you can see, it's going down. As you see the share count, 616, 613. So it's going down, which means they're buying back shares. They're decreasing their share count on the market. So total assets, you want that to be greater than total liabilities, and it is. You got 187 billion assets, 110 billion liabilities, and you want to look at the cash flow statement as well. So debt repayment, as you can see here, they're paying quite a bit down in debt. Went from 2.9 billion to 3, back to 2. Then they pay 8 billion. So the free cash flow is slightly decreased. So it was at 19, 2019, then it went to 20, 2020, 19, down to 17. So that's not necessarily what you want to see, but since this is a great company, I think they'll get it back to where it needs to be, where they grew it again. So moving on to the next stock, this is number 5. So our number 4 is going to be the Home Depot, ticker symbol HD. As you can see, the price movement last 5 days, last month they're down 2%, last 6 months up 7%, and year to date they're down 8%. And like I said before, I'm doing this stock because it's relatively close to this 52-week low. It's quite a bit lower than where it normally trades at. With Home Depot, I've been watching this stock for a long time, and it normally trades in the range of, like, on average, it was like 310 to maybe like 320-ish. That was the range that it traded in for a very long time. So it's trading at quite a discount in my opinion. So P/E ratio is 17.28, which is attractive. See some news. Home Depot protecting the climate, how Home Depot is conserving resources and reducing environmental impact. So we look at a company profile, is in a home improvement retail. They got 471,600 employees. So a huge company. You've probably been in Home Depot before if you had to fix on your house, or you wanted to improve your house, or something like that. Do like some yard work or something like of that nature. So you've probably been in one or live near one. So the Home Depot operates as a home improvement retailer. It sells various building materials, home improvement products, lawn and garden care, and decor products, as well as facilities, maintenance, repair, and operation products. So it has everything you pretty much need for your home. But let's go to the analysts. Let's see what they think on this one. Home Depot actually is projected to grow a little bit. As you can see, the sales growth next year is 3%, or 2025 is 3%. Next year is 6%, and over the next 5 years, it's supposed to grow 2.2%, which I think is going to grow more than that, especially since the fact that the share price is trading so low, which is why I say you got to buy these companies cheaper. You can't put too much credence into what analysts say, but it's good to take a look at it just to get an idea. Most of the time, they outdo what analysts say. They go over their estimates. They beat estimates. So their total revenue is 157 billion, gross profit of 52 billion. Just look at the share count. Their share count is decreasing. As you can see, 1,093,000,000, 1,074,000,000, 1,054,000,000, 1,022,000,000. So that's what you want to see. That's important. That's an important metric that a lot of investors don't look at. They got some cash on hand, 2.7 billion. So let's look at the total assets of 76 billion versus the liabilities of 74 billion. That's kind of, they do have more. That's kind of closer than I would like, but they can pay off their They can't pay off their liabilities with the assets they have. So, which is a good thing. But you normally want liabilities to be as low as possible when you're looking at the company. But since it's such a big retailer, such a big company, it's needed, and I think it's going to be around for many years to come. I'll let it slide on that part. As you can see, free cash flow went from 11 to 16 to 14 to 11. It's kind of been all over the place, but just something to keep an eye on in the future going forward. They do have plenty of it, just like the last stock. But as you can see, they're purchasing quite a bit of common stock. 14 billion, 6 billion. And you want to make sure they're not issuing a lot. That's what increases the share count, what you want it to decrease, because it helps you as a shareholder to own more of that company if it decreases. So 280, $3.26. It's issuing a little bit of shares, not too much. Debt repayment from 1 billion, 3.8 billion, 1.5, 2.4. So it's paying down quite a bit of debt, and it's also paying quite a bit in dividends. So if we look at their free cash flow of 11, dividends paid is like 7. So they're paying more than half of their free cash flow in dividends, and they're purchasing quite a bit of common stock. Not as much as they're paying in dividends, but they're purchasing quite a bit at $6 billion. Before that was $14 billion. So just some things to keep an eye on. This Home Depot is a great company. A lot of investors like this company. It's either this one or Lowe's, but my choice is Home Depot because I'm kind of biased. I've always grew up around one, and they've always had what I need, and they've been around for a very long time, and they've been continuing to improve, and they take care of their customers really well. A lot of people that work there tend to like the environment, how they're treated, and they have benefits even for the part-timers. So that's one thing to look at. So I think that was number 4. So number 3, I'm going to choose Taiwan Semiconductor Manufacturing Company, trading at $93.95 as of this recording. 5 days, 1 month, 6 months. You can see here, year to date, they're up 26.12%, which a lot of companies are down or barely up. 52-week range, the only thing with this company is it's kind of closer to its high, but I don't think it's at a bad price right now, considering what you get with this company. The PE ratio is at 14.69%, which is good, I think. Market cap $486 billion. This is one of the companies that they project to be $1 trillion company, as well as with Visa. Within the coming years, and I believe it's very possible because of how dominant this company is. Even though I normally don't invest in companies that are abroad, I usually invest in more domestic, but I made an exception for this company just of how great it is and how great of a balance sheet that it has. So as you can see, it manufactures, packages, tests, and sells integrated circuits and other semiconductor devices in Taiwan, China, Europe, the Middle East, Africa, Japan, the United States, and international, pretty much everywhere. Provides metal oxide silicon wafer fabrication process to manufacture logic, mixed signal, radio frequency, and embedded memory semiconductors. So to say all of that 5 times fast is, as you can see, some news on Taiwan Semiconductor, and this company has a little bit of growth as well. So let's look at what analysts think. So for 2024, it's projected to grow 21.20%, which is a lot. You got to imagine for this size of a company that's almost a $500 billion company, that's a lot. That's a big deal. So next year it's projected to grow 27.10%, and over the next 5 years it's expected to grow 21.50%. So this is a big deal, especially for a company like this. That's already so dominant. Growing double digits is amazing. It's what you want to see as a dividend investor. What I look for a little bit of both worlds. A little bit of growth, a little bit of dividend. As you see, they have plenty in revenue, and they're getting a lot in gross profit. And all of this money is in their currency, so it's not in USD or US dollars. So, but they're getting a lot. They're getting a lot of money. But look at their earnings. Their earnings are going up. As you can see, every quarter is a beat. And as far as revenue, it says from under $1 trillion to 2.4 trillion or close to it. They're earning a lot of money. A lot of money. So it's an overall great company. Hold on, I forgot to look at something. So they're paying out a little bit in dividends. Let's see if they can afford it. So their free cash flow is that down there, and it's increasing, by the way, which is what you want to see. The dividends paid is about half that, a little bit over half that, and that's nothing for them. Debt repayment, you want them to be paying off their debts, which in the last year or so they paid quite a bit, 118 in debt. They issued out a little bit of common stock last year. You don't want to see too much of that, but seeing as they haven't been doing that regularly, it's a good thing. So this is another pick you should look at. Number 2 is going to be CVS Health, another stock very close to this 52-week range of 73 and 91 cents, trading at a 23.83 PE ratio, 96 billion market cap, and as you can see, got some articles about it. Best dividend stock to buy: Walgreens versus CVS. My pick is CVS for the reasons I'm about to tell you. So you've probably been in one before. They all be right across from the Walgreens. Usually, that's its placement. And it's a healthcare company. They have healthcare plans. Full-time employees, 219,000. Decent sized company. This company has a little bit more of a dominant presence than Walgreens. They're pretty much in the same sector. They pretty much sell a lot of the same things, but CVS has the benefit of its healthcare, its pharmacy, which the pharmacy industry is more profitable than the just regular retail industry with the you sell little things like snacks and stuff. It's more profitable than that. So CVS focuses more on its healthcare products and things like that. Its pharmacy, that's what it's based around. But it has many products that it sells. It even has a healthcare plan. They have a constant stream of revenue coming in from that on a monthly basis, which I like to see. I like to see companies that have, which I don't know if they also have their plan where to become a member you have to sign up for it and pay a monthly fee, which I like as an investor because that's another revenue stream. So let's look at their financials. Diluted shares going up slightly, so keep an eye on that. Total revenue was $322 billion as of the year 2022. Cost of revenue is $268 billion. So they're paying a lot for the money that they receive, and the gross profit is 54. Total cash on hand, $15 billion. They got plenty of cash, do whatever they want to do. Total assets of $228 billion versus total liabilities of $156 billion, which is great. They got plenty of assets to cover their liabilities. As you can see, they're paying off debt at a high rate, $4 billion in the last year, and dividends paid like $2.9 billion, which is covered by the free cash flow. As you can see, from $10 billion went up to 13, went up to 15, back down to 13, but it's remaining pretty steady, and it's more than enough to cover its dividend of $2.9 billion, $2.6 billion, and it stays in that range where they spend on the dividend, and it's growing. So they got plenty of room for growth. So as a dividend growth investor, you should want to see this from a company like this this is what you look for. Common stock repurchase, 3.5 billion, well covered by the free cash flow. Debt repayment, 4.2 billion, well covered by the free cash flow. So those are the things that you want to look at. This is a diamond tier company. This is one of the ones that you want to see. And one of the dudes in the Discord server that I'm a part of put me onto this company. They helped me see that this is a better investment for, at least for me, than Walgreens, because I was investing in Walgreens and I was stubborn. I'm like, I was watching other YouTube channels about the hype about Walgreens and how it's going to do this, which I believe it will, but at the moment I would rather just cut my loss and just invest in CVS, who has all of this cash. They have a great balance sheet, and they're focusing on their health care. They're already at that stage, and it's just a beautiful run business. So I think you should check that out. That was number 2. Number 1, as you got T. Rowe Price. This is one of my favorite companies. It's trading at 109, 52 week range is close to its low of $93.53. Market cap of 24 billion. PE ratio of 15.98. A lot of news on it. A lot of people like this company because maybe they use the service. A lot of people like it because of its balance sheet. So the industry is asset management, financial services. Full-time employees, 7.8 thousand. Not a huge company, but they have a lot of assets under management, which is something you should check out. So as you can see, it provides service to individual investors, retirement plans, financial intermediaries, and institutions. A little bit about that there. See what analysts have to say about this. Sales growth for 2024 is 5%, which I believe they'll outdo that. Very bullish on this company. Next year, 6%. Next 5 years, they have it at -17. But like I say, I believe it's going to continue to grow. The cheaper you buy it, the more chance for gains you're gonna get. Especially if people want to own this stuff. Total revenue, 6.4 billion. Cost 2.9. Gross profit 3.5. So they got pretty good margins, because you want to look at their profit margins as well. See how much money they're making. As you can see, their diluted share count, they're lowering their shares, which is something you want to see, like I keep saying. Total assets 11 billion versus total liabilities of 1.9. That when you look at that, that's amazing right there. You're not gonna see that too often in the stock market. This is one of the very few golden companies out there with them ironclad balance sheets. So as you can see, their free cash flow, these numbers might seem low, but they're keeping a lot of their cash. They have high profit margins, and they have very little debt. So it doesn't really matter how much money they're making. If they're keeping the money that they're making, they keep a majority of it. So that's one thing you want to look at. And it does matter how much money they're making, but I wouldn't put too much on that if they weren't able to keep a lot of the money that they're making. So dividends paid, 1.1 billion. Common stock repurchase is in the millions. But I just wanted to do this. Top 5 stocks for April of 2023. I want to thank y'all for watching. I appreciate every single last one of y'all. And this is CJ Investing. I love y'all. Peace. Peace.